Good day, all. Ira Epstein with your metals market update, and this is for Tuesday, the 19th of March, 2019, just after 4:30 p.m. Central Standard Time. Now, the elephant in the room is going to be the Federal Reserve tomorrow. We have the FOMC meeting, monetary policy comes out, and because this is a March meeting, every 3 months we get what's called a new dot plot, which gives you an idea as a minimum of what the 7 sitting members of the FOMC committee think interest rates will do, but you can also get the other 12 regional banks contributing to that. That's where I think the market's going to be focused. You had a late day break in stocks as word came out that there's still bumps in the U.S.-Chinese trade deal, but I think money was looking for an excuse in front of the FOMC meeting to see maybe and take some money off the table and see what tomorrow offers. As we look in gold for the week, you're up $3.50, up 1306.50 is the last price. You've corrected from 1329.20 to a low close since that peak of 1299.20 and bounced a bit. The bias of the market remains up, in my opinion, as long as the market stays over the 18-week average of closes of 1283.70. When we take a look at a daily bar chart, you can see how the market's consolidated, working up a little bit from this break that it had right through here. You probably, if you're a Fibonacci trader, which I'm not going to put it on here, you've got about a 38% retracement of that break. Now the question is, can the market break through this high of 1311.60 and ideally stay over that if you're bullish? The pattern in the market remains one of bullishness, higher lows, higher highs. The problem had been for the market that it was settling under the 18-day average of closes. While that average is still dropping, prices today were able to close over it. So the bias is up because you're over on a closing basis, the 18-day average. That's my definition. The swing line is up because you have a pattern of higher lows, higher highs. Support, far away. Resistance, fairly far away, 1334 down to 1278. Momentum in the market, as measured by the slow stochastic, is up. So the bulls have something finally in their favor. Can they hold on to it and not allow the market to do two things? Not close back under the 18-day average, but the real number is not to get under 1292.50. When you come to the ETF GLD, the market's put, just like in the futures, itself back into the bull camp. Higher lows, higher highs. I see support at 123.17. I wouldn't want to see 122.89 taken out, and momentum is pointing up. The market that's having a problem right now, and actually could turn bearish if it's not careful, is GDX. Why? While it has the pattern of higher lows, higher highs, it is settling under the 18-day average of closes, the red line, which is 22.27. You're at 22.13. Should you take out 22.02, what happens is you get lower highs as measured by the swing line and lower lows under the 18-day average, and momentum at that time would most likely turn down. That would put back into play the potential, doesn't mean you'd have to get there, of the lower Bollinger Band at 21.45. Right now, there's nobody has control. And I say that because while the swing line is up, the bias is down. The two fight each other. The gold-silver ratio, while it peaked out in the 85.5 to 86 zone, it hasn't broken down, which means silver isn't really gaining much on the gold market. And as you can see, silver came up to the 18-day average, and it's like it hit a brick wall. I call that the line in the sand, as you know, and it just went there and ran into trouble. When it was up at the upper Bollinger Band, it fell and fought its battle there. This seems to be a battle zone. If prices fall, we'll see if they do, then 1523 support. If you take out even 1555, the problem is with the current setup, you still have the lower low and a higher high, a difficult market. In the copper market, one of the things we pinpointed early on was that the market was stuck at the 18-day average of closes. Now, the open interest in options, call options, a lot of them, options as a total though, have exploded at the Merc to an all-time record. And what you're seeing is people are making bets on this sideways action and on China. Will anything happen in the copper market because of it, or lack of something happening because they don't get a deal done. I don't know. But what I can tell you is you have a market that is just daily hitting this 18-day average. Momentum is flat. Because the market closed today at 292.30, it is under the 18-day average. So while the swing line has higher lows, higher highs, the settlements under that put the market into neutral territory. In the platinum market, the 100-day average, not the Bollinger Band, proved to be the support. The market has spun rather sharply to the upside, caught a group right here. Support should be back at the 18-day average, and what you don't want to take out is this 823.60. In the palladium, it's just the strongest of the metal markets. I realize if you go back on my tapes, I have been saying this for such a long period of time. It gets tiresome. But the market is again trying to break out to the upside. It is overbought. The first challenge of the Bollinger Band often is a problem. We'll see if it can mount anything from here, but I think the pros are taking a few bucks off the table. Wouldn't surprise me. Last in the dollar index, the trend is down. The question is there any downside in front of the FOMC meeting? If so, maybe the 95.64 area becomes a support zone, the 100-day average. Resistance is back at 96.10. And if this market were to take out 96.27, because of this break low, you'd leave the downtrend but would not begin an uptrend. You know, as I talk all this lingo, for a lot of you, you want to learn about trading. You have friends that learn it. You want to learn more. We've put together with that idea a futures trading kit, and this gives you the whole idea. We talk the history of the markets, how you get started. I'm not talking opening an account. I'm talking much more than that. The market overview, trading rules we've put together, chart patterns that you should learn, the basics at least if you're going to become a chartist. Now, if you're a fundamental trader, the heck with it. None of this makes sense to you anyways. But if you're a chartist using the leverage that commodities offer, it becomes fairly important because unlike stocks or other investments, the typical leverage in futures is what? 10, 12%, 15%? But you have an awful lot of leverage. Leverage is a two-edged sword. It's your friend and your enemy, both. Then we include videos. This gives you an idea what pivot points and a rune indicator, other technical studies might be. We even let you access and we point you to key areas on the CME Group's website. Fabulous brochures, quizzes, really teaches you, be it options, futures, what's going on. This kit is absolutely free. How do you get it? Simply go to our website at www.iraepstein.com. You'll see a carousel of free offers. Click on any of them, but be sure to click this one. Or if you need help, call my staff. They'll be happy to help you. I'm Ira Epstein. Have a great day.